Between October 1st, 2024 and November 15th, 2024, something unprecedented occurred in the quiet, fortified vaults of the global financial system. It was not a robbery in the traditional sense. There were no masks, no alarms, and no shattered glass. Yet, in just 47 days, 37.6 million ounces of silver simply vanished from the registered vaults of the Comex. To put that into perspective, that is 47% of the registered silver inventory gone in just over a month. It was the largest drain on the vaults since 1980. For decades, these vaults have been the bedrock of trust in the commodities market, a guarantee that paper contracts could be honored with physical metal. But now, the metal is leaving the building, and it is not coming back. While the mainstream news cycles were distracted by political noise and celebrity scandals, a far more ominous signal was flashing red on the other side of the world. On February 14, 2025, four of the largest banks and South Korea institutions that manage the wealth of millions did something that banks simply do not do in a functioning economy. They stopped selling silver. They did not just raise the premiums or limit the quantity you could buy. They suspended sales completely and indefinitely. When a bank tells you that they have closed the window on a specific asset, it is not because they do not want your money. It is because they cannot source the asset. It means the physical supply chain has snapped. At the same time, China began blocking its own citizens from purchasing physical precious metals through banking channels, effectively hoarding every ounce for the state. Russia found itself banned from the London trading floors, yet they continued to accumulate metal through shadow channels. The world's superpowers are quietly closing the exits, securing physical assets while the rest of the world still trades in paper promises. And right now, in the open market, we are witnessing a phenomenon that violates the basic physics of modern finance. It is a technical term that usually puts people to sleep, but right now, it should keep you awake. It is called backwardation. In a healthy, normal market, the price of a commodity in the future is supposed to be higher than the price today. This makes sense because storing metal costs money, and there is an interest cost to holding it over time. So a contract to get silver 6 months from now should cost you more than buying it right now. But that is not what is happening. Today, spot silver, the price to get the metal in your hands right now, is trading higher than the future's prices. In plain English, people are so desperate to get their hands on physical silver immediately that they are willing to pay a premium over the promise of future delivery. They do not trust that the silver will be there in 6 months. This anomaly does not happen in functioning markets. It happens when trust evaporates. It happens when the physical supply is gone and the paper promises that have been traded back and forth for decades are revealed to be worthless. This is not just about the price of silver ticking upward on a chart. This is the sound of a 1-100-N-50-year-old price suppression scheme breaking down in real time. We are watching the end of an era where paper could dictate the value of reality. To understand why this is happening now and why the vaults are suddenly empty, we have to look at the machinery behind the curtain. We have to understand a manipulation that has been running for a century and how it was designed to hide the truth about your money. Before we can fully grasp the machinery of manipulation, you must understand why silver matters more than almost any other substance on Earth. We are conditioned to think of gold as the ultimate store of wealth. Gold sits in dark vaults, gathering dust, backing currencies, and acting as a passive store of value. But gold does not do anything. Silver is different. Silver is restless. It is both money and the most critical industrial metal in modern technology. Your smartphone, the solar panels on your roof, the electric vehicle in your driveway, they all depend on silver. From medical equipment to the guidance systems of missiles, modern civilization literally cannot function without it. Here's the critical distinction that the markets ignore. Unlike gold, silver is consumed. When gold is mined, it is melted down, forming into bars or jewelry, and it stays there. Almost every ounce of gold ever mined in human history still exists somewhere today. But when silver is used in electronics or solar panels, it is often used in such small, complex quantities that it cannot be economically recovered. It ends up in landfills, dispersed into the environment, gone forever. We are burning through our inheritance. For 4 consecutive years, the world has run a supply deficit. In 2024 alone, we used 148.9 million more ounces than we mined. We are bridging that gap by draining stockpiles that took decades to build, and those stockpiles are now running on fumes. If silver is this scarce, this essential, and this rapidly depleting, basic economics suggests the price should be exploding. The reason it is not is because the price has been managed for over a century. This did not start with modern banking algorithms or the closing of the gold window in 1971. It started in 1873 with an event known to history as the crime of 1873. Before that year, the United States operated on a bimetallic standard. Both gold and silver were legal tender. You could bring raw silver to the mint, have it struck into coins, and use it to pay your debts. It was the people's money. But in 1873, Congress passed the Coinage Act, which quietly demonetized silver. This was not an accident. It was a calculated move to alter the economic landscape. At the time, massive silver deposits were being discovered in Nevada. If silver remained money, the money supply would have expanded. Prices would have risen, and crucially, debts would have become easier to pay off. This terrified the creditor class, the banks, and the wealthy who lent money. They wanted money to remain scarce and valuable so that the interest payments they collected would retain their purchasing power. They wanted deflation. The crime of 1873 was a massive wealth transfer from the poor to the rich, disguised as a boring piece of monetary legislation. It worked exactly as intended. Deflation followed, farm prices collapsed, and foreclosures exploded. The banks got richer while the farmers and workers who borrowed money to build the country were crushed. By the year 1900, William Jennings Bryan ran for president on a platform of bringing silver back, famously declaring that you shall not crucify mankind upon a cross of gold. He lost. The gold standard remained, and silver was relegated to the background, but it didn't disappear completely. It stayed in the pockets of the American people in the form of dimes, quarters, and half-dollars, waiting for the moment when its true value would be revealed. The year was 1964, and the facade was beginning to crack. For the first time, the market price of silver rose high enough that the metal inside a U.S. quarter was worth more than 25 cents. It was a moment of truth. The quarter in your pocket was no longer just a token of commerce. It was a store of wealth that exceeded the government's stamp on its face. People noticed. They started hoarding coins and melting them down for profit. The government panicked. If the citizenry realized that the metal was valuable and the paper currency was losing power, the entire monetary system would be questioned. So in 1965, Congress passed yet another act, removing silver from all circulating coins. The real money was withdrawn, replaced by copper and nickel slugs that had no intrinsic value. This should have been the signal that the dollar was in trouble. When a government has to debase its coinage to keep the system running, it is historically the last step before a currency crisis. But instead of letting the price of silver find its natural level, the U.S. government began dumping billions of ounces from its strategic stockpiles onto the open market. They flooded the world with cheap silver to keep the price down. Why? Because a skyrocketing silver price is a siren. It screams that inflation is rampant and that the currency is failing. They needed to silence that alarm while they printed money to fund the Vietnam War and the Great Society programs. By 1971, when President Nixon closed the gold window and severed the dollar's last link to gold, the physical suppression morphed into something far more sophisticated: the paper market. Wall Street created a casino where the price of silver is not determined by the exchange of physical metal, but by the trading of paper contracts. This is where the modern mechanism of control lives. Through the Comex futures market and exchange-traded funds, traders can buy and sell millions of ounces of silver without ever touching a bar or seeing a vault. Here is how the illusion works. Let's say a major bullion bank holds 10 million ounces of physical silver in a vault. In a rational world, They could sell that silver once, but in the paper market, they can sell claims on that silver 100 times over. They issue futures contracts and derivatives that represent 1 billion ounces of silver, all backed by that same small pile of metal. As long as investors settle in cash and never ask for the actual metal, the game continues. The bank collects fees, the price stays suppressed because the supply looks infinite, and the reality is hidden under a mountain of paper. This system is not random. It is a hierarchy of control. At the very top sits the Bank for International Settlements in Switzerland, the central bank for central banks. They have a vested interest in maintaining faith in fiat currencies. Below them is the London Bullion Market Association, an opaque club of major banks where massive amounts of gold and silver are traded in secret. And then there's the Comex in New York, the public face of the market. The Comex sets the rules, the margin requirements, and the delivery terms. And as history shows, when the game stops going their way, they have the power to change those rules in the middle of the night. This brings us to the most dramatic confrontation in financial history, the moment two brothers from Texas almost tore the entire curtain down. In 1979, the fragile piece of this paper empire was shattered by two men, Nelson Bunker Hunt and William Herbert Hunt. These were not day traders working from a laptop. They were Texas oil billionaires who looked at the American economy and saw a fire. Inflation was raging at 13%. The dollar was backed by nothing but faith, and the Hunts believed that the currency was destined to collapse. They decided to move their wealth into the only sanctuary they trusted, silver. They were right about the economics, but they made a fatal error in strategy. They played the game using the enemy's tools. The Hunts accumulated nearly 200 million ounces of silver. Crucially, they did not just buy the metal outright. They used massive leverage, buying futures contracts on margin. And unlike the banks expected, the Hunts stood for delivery. They wanted the metal. As they drained the vaults, the price went parabolic. In January 1979, silver was $6 an ounce. By December, it was $30. By January 1980, it touched $50. The Hunts were suddenly the wealthiest men in America, and Wall Street was facing an existential crisis. If the Hunts continued to demand delivery, the Comex would run dry. The exchange would default, and the world would realize that the paper market was a fraud. So, the powers that be did what they always do when they are losing. They changed the rules in the middle of the game. On January 7, 1980, the exchange implemented Silver Rule 7. It was a directive that sounded bureaucratic but was effectively an act of war. The rule stated that traders could no longer open new buy positions. They could only sell to liquidate existing ones. Imagine a poker game where, suddenly, you are told you are only allowed to fold. The demand was artificially cut off, while supply was forced onto the market. Simultaneously, the exchange raised margin requirements to punitive levels. The Hunts, who had borrowed heavily to build their position, were suddenly hit with calls for hundreds of millions of dollars in cash overnight. They scrambled to sell assets and borrow money, but the trap was shut. On March 27, 1980, a day now known as Silver Thursday, the price collapsed. The Hunts were destroyed, losing billions, and the Federal Reserve had to intervene to save the brokerage houses from ruin. The establishment narrative was that the Hunts were greedy manipulators who got what they deserved. The reality was that they had exposed the shortage, and the system had to break its own laws to survive. However, there is a lesson from 1980 that is often overlooked. The Hunts were ruined because they used leverage and held paper contracts. But the ordinary people who had bought physical silver at $6 and held it in their own possession, they were fine. Even after the crash, silver settled at a price significantly higher than where it started. The manipulation protects the paper structure, but it cannot confiscate what you physically hold. After the Hunts were neutralized, the manipulation entered a new institutional phase. For the next 40 years, banks like J.P. Morgan took over the role of price warden. This is not a conspiracy theory. It is a matter of legal record. In 2020, J.P. Morgan paid nearly $1 billion to settle charges for spoofing, placing fake orders to manipulate the prices of precious metals. They paid the fine, which was a fraction of their profits, and business continued as usual. But now, the mechanism is breaking again. We are seeing the return of the 1980 dynamic, but this time, it is not two brothers from Texas draining the vaults. It is sovereign nations. We are now watching the endgame of this century-long experiment in financial alchemy. The data coming out of the vaults is not just a statistic, it is a countdown. From October to December of 2024, the registered silver inventory at the Comex, the metal actually available for delivery, collapsed by nearly 50%. This is not normal market ebb and flow. This is a run on the bank. But unlike 1980, the entities draining the vaults are not two eccentric brothers from Texas. They are sovereign nations, global industrial giants, and Eastern central banks. The South Korean banks suspending silver sales were the first tremor. When major financial institutions explicitly tell you they cannot source a commodity, the debate is over. The shortage is real. China has effectively closed its borders to silver exports and is hoarding for the state. India is importing record quantities, understanding from hard experience that paper currencies eventually return to their intrinsic value of zero. Russia is bypassing the Western financial system entirely to stack physical assets. These nations are preparing for a world where he who holds the gold and silver makes the rules. The most damning piece of evidence is the backwardation we discussed earlier. The market has flipped upside down. When investors are paying more for silver today than for silver 6 months from now, they are shouting that they do not trust the Comex to exist in 6 months. They are paying a premium for reality because they know the paper promises are becoming worthless. The mechanism that kept prices suppressed, the ability to sell infinite paper contracts, only works as long as people accept the paper. That confidence is evaporating. So, what happens next? History tells us exactly how this plays out. The exchange will try to survive. They will raise margin requirements to force speculators out. They may even change the rules again, suspending deliveries and forcing contract holders to accept cash settlements instead of metal. This is the moment the market bifurcates. The official price on your screen might say one number, but try to buy physical metal at that price, and you will find empty shelves. The paper price will become irrelevant, a ghost number for a ghost asset. The real price will be whatever you have to pay to get the metal in your hand, and that price will find its own level, far above the reach of manipulation. We are staring at a mathematical certainty. Global production is falling. Grades are declining. Industrial demand for the green energy transition is devouring supply. You cannot print silver. You cannot ease it into existence with monetary policy. Physics does not care about derivatives. The manipulation worked for 150 years because there was enough legacy supply to feed the beast. That legacy is gone. This is not just about profit. It is about pattern recognition. The crime of 1873 demonetized silver to protect the creditors. The closing of the gold window in 1971 unleashed the age of inflation. The Hunt brothers in 1980 exposed the fragility of the paper market. And now we are witnessing the final correction. The system is breaking because it ran out of physical reality to sell. When the dust settles, those holding paper will hold nothing. And those holding history's oldest form of money will be the only ones left standing on solid ground. The window is closing, not because of a prediction, but because the vault doors are already swinging shut.